Buying stock options is a way to trade stocks with leverage, allowing you to control more shares for less money compared to directly buying the stock. An option is a financial contract that gives you the right, but not the obligation, to buy or sell a stock at a specified price, known as the strike price, before a set expiration date. There are two main types of options: call options and put options. When you buy a call option, you're betting that the stock's price will rise. The call option gives you the right to buy the stock at the strike price, regardless of how much the stock has risen. For example, if a stock is trading at $100 and you buy a call option with a $110 strike price for a $5 premium, you are expecting the stock to rise above $110 strike price plus $5 premium to make a profit. If the stock price reaches $120, you can buy it at $110, resulting in a $10 profit per share. $120 market price, $110 strike price, minus the $5 premium, giving you a net profit of $5 per share. On the other hand, buying a put option is a bet that the stock price will fall. A put option gives you the right to sell the stock at the strike price, even if the stock's price drops. For instance, if a stock is trading at $100 and you buy a put option with a $90 strike price for a $5 premium, the stock needs to drop below $85, $90 strike price, $5 premium, for you to make a profit. If the stock price falls to $80, you can sell it at $90, making a $10 profit per share minus the $5 premium, resulting in a $5 net profit. Options are attractive because they allow you to control a large number of shares for a smaller upfront investment. For example, one option contract typically represents 100 shares of the underlying stock. Instead of spending $10,000 to buy 100 shares of a $100 stock, you might pay just $500 for a call option. This leverage means you can achieve significant returns if the stock moves in your favor, but it also increases risk because options can expire worthless if the stock doesn't reach the desired price. The cost of an option is called the premium, which is influenced by factors like the stock's current price, the strike price, time to expiration, and market volatility. Volatility increases premiums because larger price swings make it more likely the option will become profitable. However, as the expiration date approaches, the option's value decreases due to time decay, a concept represented by the Greek term theta. One of the risks of buying stock options is that they can expire worthless if the stock doesn't move in your favor before the expiration date. For instance, if you buy a call option and the stock price remains below the strike price, you lose the entire premium you paid. This makes timing crucial in options trading, as well as having a clear understanding of market trends and risks.